Okay, let's get started. I'm going to share my screen here. You should see a screen that reads how to buy your first house. All right, so let's get started. So today I'm going to take you on a little journey of the whimsical world of homeownership, but on the lending side of things. So imagine this, you purchase your first house, you walk up to the front door, you put your key in, you turn it, you're met with that satisfying click. And you push open the door, and there it is, your very own castle, ready to be filled with memories and laughter and maybe some furry friends. You'll see there's something special about homeownership. You can paint the walls the color that you want. You can plant a garden. You can hang a hammock out back for lazy Sunday afternoons. It's a space that tells a story about you. But before we dive into this exciting adventure, let me introduce myself. I am Melissa Foreman. I'm a mortgage agent, and my mission is to guide you through the maze of home financing. Embarking on this new adventure needs to have the right map, a mortgage that's tailored to your needs. And this is where I come in. I'll help you decipher the puzzle of interest rates, demystify down payments, and ensure that your journey is as smooth as it can be. Buying a home can be exciting and rewarding, but it also can be challenging and confusing, especially if it's your first time. So today we're going to break down the process and let you know what you can expect. So this is about me. I'm Melissa Foreman. I'm investing in real estate for over 17 years, including my own personal houses, rental properties, land that I've rented out to farmers. I'm with a company called Centum Financial Services, and I specialize in first-time home buyers and real estate investing. My title is a mortgage agent. So what does that mean? Think of me as your personal concierge to the vast world of mortgages. You'll see that I'm not tied to any particular lender or bank. So think of me like a wizard who has access to a spell book of lending options. This means that I have a vast array of lenders and products to ensure that you get a mortgage that suits your needs. And not only in the terms of rate, which is very important, but also in the terms of product. No one reads the fine print until they absolutely need to. So that's what I do for you. And how this works is that there's several different lenders you can borrow from. Banks are one of those lenders, but they're not your only lender. I work with over 60 different lenders in my portfolio to find the lender that works best for you. How I get paid, often something that comes up, you don't have to pay for my services. I get paid through the process. So when I deliver you to a lender, they pay me like a referral fee. So I broke down into 5 different steps here. The first one, getting pre-approved. Remember this term because we're going to talk about it on the next slide. This may or may not be the first step for you. It can be a major step for people because it gives them the better understanding of what they can afford to get started. Second one, down payment plus. So down payment, this one can be confusing. I often get calls from realtors asking me about specific properties because the down payments aren't straightforward. So we're going to break that down in a future slide. The plus is for closing costs because we also have to account for closing costs when we're looking at purchasing a house. Building your team. You're going to need a team of professionals to complete your purchase. And we're going to talk about that. Product and rate. So after I collect your documents, we do credit pull, we talk about products and rates. What are the best options for you? So we look at everything before we dive into that. Finding the home and closing. Closing is an important part of purchasing, and what does it look like on the final day when money is being exchanged? All right, so remember what I said, remember that term on the previous slide, pre-approval. So there's 2 terms that get thrown around a lot. One is pre-qualified, one is pre-approval. They sound the same, but they're completely different. And so you can compare these 2 things, like say your car breaks down or is making a funny noise and you want to go get it fixed. A pre-qualified would be like calling the shop, talking to the person who works behind the desk and telling them what's going on. They may or may not have an idea. They may tell you the right thing. They may tell you the wrong thing. Really, they don't have a lot of information to go on. Also, they're not really the specialists that would do that. So first is a pre-approval. A pre-approval would be like driving your car into the bay, opening up the hood, looking in the lifting thing, plugging it into different diagnostic tests, and really having a look at the car to be able to diagnose what the problem is. So that would be basically what the difference between the 2 would be. Pre-qualified is based on the information given by the buyer. So it gives a rough estimate of what you might be able to afford. It's not verified by a credit pull. It's not submitted to a lender, and there is no rate hold. Whereas a pre-approval, there are documents that are submitted to be able to give your max purchase price. It's more of a accurate estimate because you are submitting documents that you need to submit for your mortgage regardless. Also, it has the accuracy of a credit check. And from my experience, it's really great to pull the credit early because if there's things on there that shouldn't be on there, they can be dealt with before you're in the process of purchasing a home because they usually take a few months to rectify. Also, it's submitted to a lender for review and you get a rate hold for a certain amount of days set by the lender. So when we talk about documents, what documents do we need? Types of documents that are required. A major part of the process, whether it's pre-approval or for the actual purchase itself, is document collection. And these documents are proof to the lender that what you're stating is actually true. And this slide represents different types of income that are required for specific situations. Let's look at the first one because it's the most common. So full-time employment. Full-time employment, so you're going to need 2 recent pay stubs to show that everything's on track and consistent with previous years. An LOE is your letter of employment. This will state your start date, hours guaranteed, and your hourly rate. 2-year T4, your T4s are what your employer gives you at the end of the year to do your taxes, and your NOAs. So your NOAs are your notice of assessment, and this just goes to show the lender that you're in good standing with government taxes. Then with those, what are the lenders looking for? Lenders are looking for 1, a stable income. This is your income and employment history. This shows that you have the ability to repay the outstanding debt. Lenders like to see a 2-year employment history, either with the same employer or in the same profession. And then 2, good saving habits, so assets. It's always a bonus to show that you have assets like investments or saving, paid off vehicles. This goes to show that you have the characteristics of someone who doesn't spend every dollar that you get. You save for a rainy day. 3, strong credit history. So someone anywhere from 660 to 900 is considered good, very good, or excellent. We will be discussing credit in a future slide. Buying within a budget. So lenders have a couple of ratios that must be met for debt load when you're looking at your max purchase price. And we will be talking about those ratios. A marketable property, it's a real estate term that is thrown around sometime, which just means that the property is free from defect. A lender wants to make sure that the property that's being purchased is marketable. So if it needs to be sold in the future for the purchase price, it can be. It's always a good idea to send, if you're looking at a property and you're not sure if it's marketable, to send it to your mortgage agent to have them look it over to make sure that it is a marketable property. We're going to talk about assets next. So what are assets? Well, assets are a collection of your cash, liquid, non-liquid investments. Your assets basically make up your net worth, and they can be your TFSAs, RSPs, first-time home savings account. Non-liquid could be vehicles, recreational vehicles like boats or RVs, other properties that you have, and cash. So checking, savings, gifted funds. So gifted funds that can be used for down payment. Gifted funds that can be used for down payment need to come from an immediate family member. Parents, siblings, spouses, that's it. And this is because the lender wants to make sure that it's not a loan. So you can't get a gifted fund from a neighbor or cousin because that would have to go against your liabilities. For your down payment. And the down payment, it is a really important part of the purchase, but it's also a really tough thing for people to save up for generally. So let's have a look at down payment. What is down payment? It's a sum of money that the buyer pays in early stages of purchasing. This portion of the total, it's a portion of the total purchase price. And there's a lot of rules around down payment. So let's break it down. And I have a little cheat sheet here to kind of but let me break it down for you. So in most cases, you need a minimum of 5% on the first 500,000. So $0 to 500,000 of your purchase price, you need 5%. 5% to or 500,000 to $1 million, you need 10%. And then anything over that million mark is 20%. So when you're purchasing a property like a 600,000, you're going to need 5% on the first 500,000 and then 10% on that extra 100,000 that's over that 500,000. So it ends up being 35,000 that is required as a minimum down payment. It is also important to keep in mind that on top of down payment, you have closing costs that need to be budgeted for and estimated between 1.5 and 3% of your purchase price as additional expenses. So those additional expenses can look like home inspections. Often a realtor is going to recommend, if you're not some kind of construction or house guru, to get a home inspection, especially when you're purchasing your first property. Legal fees. You need a lawyer to complete the transaction when purchasing a property. And they have many roles that include reviewing agreements, ensuring that the property is free and clear of claims, or and they arrange title insurance, they draw up mortgage documents, they transfer money on closing day and make sure all those transactions are legal and the financial conditions are met. Ongoing costs, so bills, repairs, renovations, upgrade, you have to plan for those. Appraisals. When you submit to a lender, they may or may not ask for an appraisal, so it's a good thing to plan to have to pay for because that comes out of your pocket. Mortgage insurance, if you're putting less than 20% down, you need to pay mortgage insurance. And when I say mortgage insurance, the insurance is for the lender, not you. So when you put less than 20% down, you purchase mortgage insurance, that is for the lender. That gets rolled into your mortgage, so it isn't something that needs to be paid out of your pocket right away, but it's also a really good thing to keep in mind if you're putting less than 20% down, because it is an additional expense. Land transfer tax. So there is a rebate for first-time homebuyers of $4,000. Land transfer tax is based on your purchase price, but there is that rebate that's offered to you as an incentive for a first-time homebuyer. There are other incentives that are offered, and some of them are the home buyers plan. So your RRSPs, you can use up to 35,000 of your RRSPs tax-free. You need to pay it back over 15 years. If you don't end up paying back, you just have to claim it as income. There's also something new called the first home savings account. You can save up to 40,000 over a 5-year period of tax-free contributions. So when you put it in, you get that tax rebate. Any money that's made on that money is tax sheltered. And then when you pull it out to use it as your down payment, you still don't pay taxes. So it is quite a good program. Who is considered a first-time homebuyer? Someone who hasn't purchased a house before. A lot of people don't know this one, but individuals who have separation agreements. So if you're breaking up with a spouse and you have a separation agreement, you need to purchase a house, you're now considered a first-time homebuyer again, so you can use your RRSPs. Another one is people, maybe you've owned a home before, but people who haven't owned a home or lived with a spouse who has owned a home in the past 4 years can reuse your first-time home savings incentives like RRSPs again. The next slide, we're going to talk about those ratios that we spoke about previous to determine your max purchase price. And I just wanted to touch on this because I think it's really important to see how these things can be affected when we're talking about max purchase price. Lenders have a couple of ratios that they look at. They both include your mortgage and your tax, your municipal taxes, and some expenses. So the first one is GDS. It includes your mortgage, your municipal taxes, heating costs, and half of your condo fees if that's applicable. Your housing costs shouldn't exceed, your GDS shouldn't exceed more than 39% of your gross annual income. The second one is your TDS. It includes everything that the GDS includes, but it also includes your debts that you pay on monthly. So credit cards, car loans, line of credit, student loans, alimony, child support, those sorts of things. So all of your house expenses plus the debts that you pay monthly need to be less, cannot exceed more than 44% of your gross annual income. And it's because when we look at affordability, we need to make sure that you can, that the lender wants to see that you can afford to pay those debts off. So if you're looking to purchase a house and you've gone out and purchased a 2023 G-Wagon and your monthly payments are $2,681 a month, now your GDS is under 39%, but now your TDS is 120%, you're not going to qualify for a mortgage. So it's really important to keep those monthly costs down if possible. On the next slide, we're going to compare two applicants here. Both of these applicants make the same amount of money. They have the same down payment, but they both have vastly different affordability for max purchase price. And that's because applicant one has a lot of debt, vehicle payments that they have to pay every month, credit card balance, line of credit, student loans, whereas applicant 2 doesn't have a vehicle payment or a credit card or a line of credit or student loans. And I realize that all debt is bad debt, and we need debt to be able to build our credit up. You have to use credit and pay credit to show that you are good at paying credit. And that is valued on your beacon score or your credit score, something that we talked about briefly in one of the previous slides. And it is a 3-digit number, typically between 300 and 900, designed to represent your credit risk, the likelihood of whether you're going to pay your bills on time or not. And these things are based on calculations from information of your credit report. When you borrow money on credit, how do you pay it back? Do you miss any payments? How close are you to your max? You want to keep it under that 30% to have the best credit that you can. So if you have a credit card of $1,000, you want to keep it under that $300. You want to make all your payments, make sure you pay things on time. Credit scores between 660 and 900 are considered good, very good, or excellent. And listed here are some ways to help improve your credit. So just paying your bills on time, keeping it under that 30%, only apply for credit when you need it, those sorts of things, use it or lose it. So you do need to use your credit and pay it off. And now that we've looked at your max purchase price, let's look at rates. So this is a major topic for everybody right now, because everybody wants to talk about fixed versus variable rates and the BOC up and down with their rates. So first, I want to get that there are 2 numbers in this time that are associated with your mortgage. So your amortization and your term. Your amortization is the entire length that you have your mortgage, and your term is the short period that we negotiate. It usually looks around 3 to 5 years. So that's when we pick whether we want variable or fixed rates, okay? And this is all decided on what's going on in the market. Most people, what they're doing, those people that get paid a lot of money to decide what's going on. After we collect all your documents, figure out what your max purchase price is, look at your credit, that's when we have these conversations of what's best fit for you. Okay. And then after all of that is done, we've picked all our product. This is the fun realtor stuff. The realtors get to do the fun job. So they get to find you the right house. And things that are really important when finding the right house are location, size, special features, and lifestyle. So if you are planning on having a family, maybe this house is perfect for you right now, but are you going to be able to stay there? Because buying and selling and paying land transfer tax fees can be quite pricey. So you want to make sure you're planning for now and your future. And then on closing day. So closing day is an exciting time. It's the time when you take the legal possession of your home. It's a final signing, generally happens in the lawyer's office. And the lawyer receives the mortgage funds and from the lender, and you provide the down payments and you get the keys to your house. So it is a really important day and very exciting when everything funds and goes flawlessly. So I just want to thank you for listening to this presentation. I know it's long and there's a ton of information. Please take the time to reach out if you have any questions. My information's here, my email, my phone number. Give me a shout, send me an email. Watch this video again, it's recorded. So, and then let me know how I can help you be a first-time home buyer. Okay, thanks.